Hello, everyone. On behalf of the Counselors of Real Estate, welcome to Global Property Markets, Trends, Cultures, Perspectives. Thank you for joining us. Today's webinar is a compelling follow-up to the CRE European Chapter's very successful international conference held last month in Prague. Those of us who experienced it won't soon forget it. It was excellent. I'm Bill McCarthy, CRE Global Chair of the Counselors of Real Estate and President of WPJ McCarthy and Company in Burnaby, British Columbia, Canada. The Counselors of Real Estate is a distinguished international group of accomplished advisors solving the world's real estate challenges. Experienced, innovative, credential problem solvers, counselors reside in 22 countries, including those represented through our brand new Asian chapter. Welcome. Counselors offer expertise in 60 real estate disciplines across all asset classes and have earned the prestigious CRE designation. Let's recognize our What's Next webinar series sponsors: Altus Group, USAC Real Estate, Equus Capital Partners, and WPJ McCarthy and Company. Thank you for your support. Before I begin, I'd like to offer you a free subscription to the Counselors' peer-reviewed professional journal, Real Estate Issues. If you don't already subscribe, please visit our cre.org/REI. You're encouraged to utilize the Q&A feature should you wish to submit a question to today's panelists. Your participation is welcomed and we'll answer as many questions as time allows. I'm very privileged to introduce today's moderator, Kai Pan, CRE, Executive Managing Director and National Head of Multifamily Housing for JLL Valuation and Advisory Services in Houston. Kai works with JLL's multifamily appraisal teams across the United States. He received JLL's Top Gun Award in 2017 and again in 2018 for his exceptional focus on trust, partnerships, and the success of their clients. Prior to joining JLL, Kai served as the Director of Integra Realty Resources in Houston and was a member of its senior housing, healthcare, and hospitality service practices. A licensed appraiser in 22 states, Kai also holds the Appraisal Institute's MAI designation. Welcome, Kai.
Thank you, Bill, and hello, everyone. Welcome, everyone. My name is Kai Pan, and the topic of today's panel is global property markets, trends, cultures, perspectives. Global investors want to have a high level of trust in the markets they invest in, ultimately leading to investment decisions with greater confidence. The reason we're here is to learn about global markets and improve the transparency of our markets to a global audience. The JLL Global Real Estate Transparency Index is a unique way of measuring how real estate markets operate across the world and benchmarking transparency. The index is based on a combination of quantitative market data and information gathered through a survey of global business network of JLL and SL across 94 countries and 156 city markets. The markets are benchmarked on each of the 6 sub-indices: investment performance, market fundamentals, listed vehicles, regulatory and legal, transaction process, and sustainability. Improving real estate transparency is critical because investors gravitate to transparent real estate markets where risk can be better managed. Access to high quality supply, demand, and performance, the higher the transparency, the higher the investment activity. Here to share their insights on their prospective markets, my esteemed panelists today are Hans Vrensen, CFA, CRE, Managing Director and Head of Research and Strategy at AEW. Hans is responsible for directing the firm's research activities in Europe. Based in London, he is a member of the AEW European Investment Committee and a member of the firm's Global Securities Allocation Committee. Dr. Leonard Meyer Brickwedde is the President and CEO of Kensho Investment Corporation. Dr. Meyer established Kensho Capital Corporation, carried out the business, real estate investment advisory services, real estate fund, and real estate asset management to provide access to the Japanese market for European investors. Hans, Leonard, and I will share our respective perspectives on property markets in the Americas, EMEA, and Asia regions. We'll kick off with Hans on his views on the European market, then with Leonard on his presentation of the Japanese.
Great, thanks very much, Kai, for that introduction, and also Bill for your kind words about the conference in Prague, which I agree was a very memorable and an exciting expansion of the councillor's activities internationally. So my presentation for today is a summary of some of the views that we shared in Prague, which was based on our mid-year outlook. For those of you that don't know AEW, AEW is a global real estate investment management firm. We have offices around the world, but our main offices are in Boston, Paris, and in Singapore. My responsibilities are solely focused really on the European market. We, of course, do talk with our colleagues and clients from across the world, but my remarks will be focused on the European market. And what has been happening around the world really is since the COVID situation has been that inflation has stepped up, and central banks have announced new policy initiatives. So my presentation is linking into that. So maybe if we can have the first slide, we can get started on what that means for the European market. And so what I'd like to start out with here is to show the magnitude how borrowing cost in European real estate markets has stepped up. Now, there is a difference between the US and the European markets, where in Europe we have a floating rate of interest on most of our commercial mortgages. And so I have two elements to the borrowing cost. One is the margin of the loan itself, and the second element is the swap rate. That is the swap rate to fix the interest rate from a floating rate to a fixed rate over a 5-year period. And you need to add those up together to get to a borrowing cost. That's an all-in borrowing cost. And what is very clear from this chart is that, first of all, both for the UK and for the EU average, that the borrowing costs have stepped up significantly over the last, call it, 18 months. And that is mostly due to the swap rates. Now, the swap rates are tied closely to government bond yields. We'll come to that in a second. But you can see that actually the margins on the loans, that is the red bits and the yellow bits, that actually margins have been relatively stable. They have stepped up, but not by as much as the swap rates. And this is obviously going to have big repercussions if, instead of borrowing money at, say, 1 or 3%, all of a sudden you're facing a cost of borrowing money at 5 or 7%. For real estate investors, that has big repercussions. And so most of all, it has pushed out the initial yields, or cap rates as Americans call them, across the investment markets. So I'd like to start with that, but then behind the scenes, of course, there are some macro trends that are driving this. So if we go to the next slide, you can see some of these coming through. And even in today's news, we can see that the ECB announced another rate hike following the Fed from earlier in the week. So perhaps not a big surprise, but you can see that the policy rates from central banks, we are showing here only the Bank of England and the ECB, that they have both stepped up. And for your convenience, we've also put those swap rates in. They're not directly correlated, as you can see, but they are moving in a similar direction. Now, the reason why central banks are stepping up their policy rates is, of course, the inflation that I mentioned earlier. Here we are showing both core and headline inflation for the Eurozone as well as the UK. Again, a very big difference between the two, where the Eurozone inflation has been quite a lot more moderate and has also started to come back down a little bit quicker than what we see here in the UK. So, and that is of course then tied to the bond yields as well. It is important to note that inflation has started to come down much more quickly now in Europe, partially because the energy contracts in Europe are a little bit more floating, where some of the contracts that people have here in the UK, if energy costs come down, they are not immediately translated in the overall inflation numbers. So these two are very closely tied together, and so this will also have repercussions for the way that we look at real estate. If we go to the next slide, we can see some of these quite significant drivers, and these are really, I would say, the two biggest drivers for our forecast. We do forecast of about 200 different European market segments, and they are driven by particularly bond yields. And so on the left-hand side, you can see a chart that's showing the bond yields, the government bond yields on a 10-year basis across the 20 countries that we cover. And you see also our previous base case downside and upside scenario that we presented in March. Just as a sanity check, we double-checked the latest forecast from Oxford Economics as well as actual announcements, and you can see that the black line, which is the June 23 base case, is actually still in line broadly with what we saw on the base case back in March. A little bit elevated, but not materially so. In the case of the GDP, that's actually the same, where the June actuals and the updated forecast are not that far removed from the base case scenario that we had back in March. And that is comforting, because even though we saw a short and shallow technical recession in the Eurozone, we had a growth of minus 0.1% in both the fourth quarter of 2022 as well as the first quarter of 2023, which does constitute a technical recession. It's very shallow, and the full year forecast for GDP growth in the Eurozone and especially also for the UK are still positive. So that means that actually we don't need to worry too much about switching to our downside scenario. Now, that is a very good situation from my perspective, because that has not been the same over the last few years, especially with all the trials and tribulations that we had with the COVID lockdowns and some of the other shocks that we've been having. So we're getting a little bit more in a stable situation. So if we move to the next slide, we can then also look a little bit at the repercussions on transaction volumes. And so this data on the left-hand side is coming from our friends at MSCI RCA, who actually just yesterday announced the volumes for the second quarter of 2023. They are still significantly down. They're down about 60% compared to the previous year-to-date numbers, but we are still ahead to equivalent numbers in 2009. There is obviously a big impact. You can see it from the chart, but we don't have the full year numbers yet. Based on some of the data that MSCI presented, we have also not a lot of pipeline of deals. So it's very, very likely that we will come out close to, like, say, 2010 or 2011 sort of volumes across the European markets. The chart on the right-hand side is also trying to put the current cycle in perspective with the previous cycle during the global financial crisis. And so if I just explain what this is, it is actually quite a positive message in my view. On the left-hand side, you see across the major European markets, the historical growth in capital value as well as the decline in the GFC period. And you see especially strong stability in Germany, but the UK saw a decline of nearly 50% post-GFC. This time around, if we look at the current cycle that we're in, we obviously have already seen a correction in the European markets, and that's the orange bits on the right-hand side. But based on our forecast, there will be still further capital value declines coming through, and that's the dark blue bits. Now, the good news in my mind is that most of the value adjustments that we expect based on our forecast have already taken place. There is still a little further reduction in capital values that we expect for the rest of 2023. But after that, we do expect a recovery to start coming through. However, the precise timing of this recovery is a little bit uncertain because of what I said about the interest rates. So if we go to the next slide, I can illustrate some of the work that we've done to highlight the impact of the interest rates on the market from a different perspective. And so on the left-hand side, we are illustrating the way that we calculate a debt funding gap. Now, the debt funding gap is trying to estimate the overall impact of increased interest rates as well as declining capital values on the refinancing of existing loans that were written in the past. So as an example here, I'm showing UK retail transactions going back to 2018. We assume a 5-year maturity of the loans that is in line with what we see across the markets. Of course, not all loans are 5 years, but the majority is probably in line with that. We see, and this is actually, again, data from RCA that we use. We see at that point in time in 2018, about 8 billion in total deal volume. We see an LTV of about 60% at that point in time, which means that we had about 5 billion in debt that was created, originated in that year. We know from the data from CBRE that capital values came down about 50% already over this period of time when the loan matures in 2023. And that means that the new asset value at the loan maturity of this 2018 loan will be about half of the original value. Also, we think that lenders will have become more conservative. This is based on some survey data, but also on actual loan to values in the market. We expect the loan to value ratio to have reduced to 50%, but that is of the new value. That means that only 2 billion of debt will be available to refinance the existing debt of 5 billion euros, leading to a shortfall of 3 billion euros for this particular vintage and market segment. Now, if we repeat this analysis, and of course, this is the most extreme example that we can use. This is the sector that has shown the biggest capital value decline so far. But if we repeat this analysis for loans originated in 2018, 19, and 20, for both the UK, Germany, and France, as well as for other property types, including not just retail, but also offices, residential, and logistics, then we get the chart on the right-hand side, where we can aggregate the debt funding gaps across the countries, across the vintages that are coming through. And you have a picture of about 51 billion euros of debt funding gap, which sounds like a lot of money, and of course it is, but to put it in the context, we think that this is only about 60% of the debt funding gap that we had expected post-GFC. So we have a problem, certainly. We have less of a problem than in the aftermath of GFC. And another benchmark is that these refinancings make up about 22% of the original loan origination in the period of 2018 to 2020. So we definitely have a refinancing problem in Europe, probably not that difficult to understand for those of you active in the US markets, but we are dealing with this, and there's been a lot of restructurings, loan extensions, The only difference that I would say this time around is that instead of lower interest rates, which we were very fortunate to have in the aftermath of the global financial crisis, we of course have much higher interest rates, as I showed in my first chart. But regardless of these refinancing issues, and to be fair, in the transaction volumes that MSCI is showing, we are not yet seeing a real big increase in, for example, distressed sales. We do expect these issues to be dealt with and have some repercussions on transaction volumes. But also interest rates are increasing yields, and when yields increase, capital values are adjusted. So for new investors that buy at today's prices, the situation is likely to become better because the capital values, the price that you need to pay today is going to be lower. So and if we switch to the next slide, I can illustrate a little bit what we are expecting going forward. And this is work that we've done on a relative value framework. And let me try to explain it in a couple of minutes because I know I'm running out of time. We have a required rate of return that's on the left-hand side, and we have a expected rate of return that's based on the income and the capital growth that we foresee across our markets. On the current 5-year hold, if we just stick with 2023 as a starting point, we actually do see that given the capital value declines that we've already seen, as I showed you earlier, most of the declines are already behind us, that in today's European market, we think that the majority of the markets are actually fairly priced. However, if we jump ahead and look at 2024, based on our current forecast, we do expect that with further yield widening to basically erode capital values by year end, that if you start buying in 2024 at the lower capital values, that actually a normalization of the cap rates going forward, since bond yields are expected to normalize, you would expect to see a bit more capital value growth in the 5 years after that. That means that the expected rate of return will be exceeding the required rate of return a lot better. It's just a different way of saying that we think the cycle will become much more attractive for investors. And that is, of course, most attractive for investors that maybe don't have a lot of legacy issues to deal with, that have allocated capital to the region. And so I think the key message that we have been putting to our clients is that don't wait too long, because if you wait too long, you might miss the turning point in the cycle. We do think that for investors that have a long-term horizon, that late 2023 as well as 2024 will be very, very good time to come back into the European market if you have taken a break from that. So Kai, that is what I wanted to talk about. Happy to take questions later, but I think we're switching to Leonard first, right?
Thank you, Hans. Yes, and apologies for the technical difficulties earlier. But yes, Leonard is up next to talk about the Japanese market.
Okay, well, thank you very much, Kai. So you see here on the first page, we are already July 28. It's 1 o'clock or 1:23 right now. Kensho Investment Group is a company here in Japan, in Tokyo, that serves cross-border investors in 2 directions. Number one, we serve European investors to invest in the Japanese real estate market. And on the other side, we guide also now that Japanese investors become increasingly interested in overseas investments. We serve Japanese investors to go abroad, and we support their activities in Europe. Then can we start with the first slide? Okay, in my presentation, I would like to touch upon 3 things. The first one is decoupling of Japan from the developments in Europe. The second page will then be about Japan as the likely winner of, or Japan as a winner of deglobalization. And then I will show on the third slide that Japan is a country, in my view, that's one of the greatest strengths of Japan. It's a country where capitalism works. And I will show this to you with some examples. So starting now with this second page, decoupling of Japan from the developments in Europe. The biggest area where Japan is decoupling is that Japan is not raising the interest rates. The governor of the Bank of Japan has just been 2 months ago taken up his role as governor, and he has confirmed clearly that the zero interest rate policy will remain in place until the inflation, and when he says inflation, or when the Bank of Japan says inflation, they want to have a domestic inflation in Japan, and they do not want to slow down the economy as long as inflation is only because of imported inflation. Higher material prices, higher energy prices are the main factor why at the moment the Japanese inflation is above 3%, but we still have not seen wage inflation. And the Bank of Japan wants to see a sustainable wage increase of 3% in order to have certainty that the inflation has sustainability at a level of 2%. What the Bank of Japan is doing at the moment, they're spending a lot of money to buy government bond. Whenever the government bond comes close to 0.5%, the Bank of Japan jumps in and buys those government bonds to keep the interest rate also flat. The 10-year government bond should not exceed the level of interest rates 0.5%. The second point is, and that is different from many other G7 countries, Japan has a strong government that has just been re-elected 1 year ago now. It has a strong majority and thereby does also turn things around. Especially as a German, I have to say that this is very different from what I see in my home country, where things are not really moving forward. The fiscal policy is focusing on shareholder value. It is targeting to increase the investments by institutional investors. Japan, different from other countries, is, for example, not trying, and there's no discussion on capital gain tax, on the promotion of capital gain tax. And also on the retail side, the government wants to, also the retail investors, increase their investments into the stock market. Therefore, the government has just increased the amount that individuals can invest into stocks and bonds, and they don't have to pay tax on dividends and on capital gains. So up to 8 million Japanese yen, or 60 million, or 60,000. This is wrong. It should be 60,000 euro can be invested by an individual without having to pay capital gain tax or dividend tax. And the last point is Japan feels secure, more secure than most countries about energy. Energy also has to be imported, part of it, but Japan is also considering to restart idle nuclear reactors and thereby have enough power that the country needs. This concludes my second slide. We can go to the next one. Here I talk about Japan as the winner of, or one winner of, deglobalization. We have seen the stock market going very strongly this year. We have on the 3rd of July passed the 30,000 mark. The TOPIX is at a 33-year high. And the country is benefiting strongly from friend sourcing or shoring, meaning the dependence, especially now here in the semiconductor area, the dependence on Taiwan should not increase further, or companies are looking for ways and means to secure their supply line by building semiconductor plants and doing other investments here in Japan. The third point is here that also the attitude of Japanese companies is stronger, focusing away from cost cutting and overseas production to now onshore investments in Japan, into factories in Japan. Both industry and also the service sector are investing into factories, logistics centers, hubs, and tech infrastructure. And the second point is we see strong investments into labor. We see people be brought into the companies. We talk here at the moment about the golden generation. The golden generations are the ones who are now 23 and are graduating from university. And for this year in May, the graduates who will graduate in March of next year, 98% of those graduates have already job security found. Last point on this, Japan as a winner of deglobalization is also that Japan is the focus of many strategic alliances, strategic trade agreements. I have mentioned a number of those here because other countries are seeing that they need Japan as an alliance, as a partner within Asia. Then the next slide, please. I always like to point out that in Japan, capitalism works. What I mean is the Japanese CEOs and the companies are not looking at only the shareholder, but also at the whole stakeholders, vendors, also the employees. And also when it comes to the reward of CEOs, Japan is more moderate than what we can see in other countries. So while the topics companies have improved their profits since 1995 by 11 times, the US Standard & Poor's index companies have increased their profits by 6 times. So both are good numbers, a good increase. But when you look into how much do the CEOs benefit, US CEOs benefit about or participate or get an average salary remuneration that is about 400 times larger than the average salary in the company, where in Japan, the CEOs of the 50 largest companies receive just 40 times the average salary. So the CEO of the top 50 companies has to work at least 1 week to earn the money that the average employee earns. For the average of all topics companies, the CEO earn about 11 or 12 times the average salary. So this results then also that the workers, there is homogeneous thinking in Japan, and workers return to office. We have no specific vacancies because of home office work. Home office work is also here a topic, yes, but it is only an alternative, but not a demand that people want to work 3 days from home. So trends like quiet quitting and slow living are unknown in Japan. And on the other side, also, the government is able to increase the share of people who work of the total population has been able to increase this share from 51% to 45%, meaning in the last 5 years, the employment in Japan, there are 2.5 million almost more people employed, while the population itself went down by 3.6 million, the Japanese population. So there's more part of the citizens in Japan that participate in the labor market. So if we turn the last slide, my conclusion for this presentation is that for a foreseeable future, Japan will continue to play a specific role in many areas. And this is something that investors, overseas investors, should put attention to. The Japanese market will, for some years to come, outperform because of these reasons, these trends that I have just mentioned before. They are not short-term trends. We may see a change by the Bank of Japan that also in Japan interest rates may go up, but we will see moderate changes. And for the time being, there is no change to be expected. The first thing that the Bank of Japan may do is that they take away the cap on the 10-year government bond and will stop to keep that rate at a level of 0.5%. But we do not expect any significant changes to the interest rates in Japan. That concludes my presentation. I think I will answer some questions about the market and what is going on in the market with regards to real estate during the question and answer session.
Thank you, Leonard. And thank you, Hans. I have a question for you, Leonard. You mentioned in Japan, capitalism works, great slogan. I think, the global property transaction market, has been down across the board. We've seen that in Hans's presentation, but it appears that the Japanese property transaction market has been on fire. JLL research has shown that, the transaction volume has been up year over year in 2023. What's behind this dynamic?
You still have a positive income over the risk-free investment. So the government bond at 0.5 and the cap rate for residential Tokyo maybe 3.5%, office around 3%. So you have a positive yield back gap in Japan. You do also get financing of 60, even up to 80%. We have recently arranged a large transaction of over 80%, and it's available. And the costs of capital are also relatively low, relatively to what I see in Europe and in America. You get financing at around 1%, 5 years.
Wow, that's amazing. This next question is for Hans. Interesting observation about in the Eurozone, the falling capital markets have obviously triggered refinance issues in the US. We're obviously no stranger to those issues. We've heard of the maturity wall in the next few years. There's a good amount of debt that is at risk with the SCR less than 1.25. Question for you, have you started seeing any emergence of the non-performing loans in the European market? And just kind of piggyback off that, you mentioned kind of restructuring and loan extensions offered by the lenders. What comes with those restructuring and loan extensions? If you could expand on that, please.
Yeah. So the answer is on the first one is no. We haven't really seen a lot of non-performing loan transactions yet. It's perhaps a bit too early for that. I think banks are. I mean, we have heard some talk about one or two loan sales maybe, but not a structural NPL market that we had in the aftermath of the GFC. Now, these do typically occur with some delay. So I think what I'm hearing from the market is that most of the lenders are again not in a position to take over the management of the collateral that they might have the ability to enforce under the advice that they have in the current loan agreement, but they would prefer to work with the existing borrower to work on a plan to basically restructure. And what I expect is restructures are probably shifting down the road for the next 2 years. And if we see a normalization of interest rates and they see growth coming through, some of the features of the capital could be such that we see a capital value recovery, we could see income still increasing. In the European market, we do have one big advantage, is that we don't have a lot of oversupply of buildings, with the potential exception with some of the office markets, I would say. But that means that a restructuring for say 2 years could just lift the position out of deepest problems. Although I do expect that there will be plenty of loans that even after a year extension will still face such big hurdles that at that point the bank might still, after taking write-downs, they might still look to sell some of those positions. So it's a little bit too early to tell, but we haven't seen any transactions come through. Again, one of the big advantages of the European market, in my view, is that the regulations of banks have been quite tough. They have not been lifted because of political reasons or to establish higher growth rates, like we have seen, potentially in the US a little bit. That means that development activity has been modest. And oversupply has been limited. Also, banks have been lifting their capital ratios, so tier 1 capital ratios, which are the reserves that banks have set aside on their balance sheet to deal with potential losses that will come through, not just from commercial real estate, but also from other sectors. Those ratios have been stepping up, and so I think that most of our banks will be ready to deal even with write-downs or NPL sales if we see that in the future.
Yeah, thanks for the comparison between the European and the US banks. Obviously, the banking sector in the US is a hot topic with failures of Silicon Valley, Signature, and just recently the acquisition of Pacific Western by Bank of California. So interesting comparison and contrast between the two markets there. So next question for Leonard. Can you share a little bit about Japanese institutional investors' activities overseas and what to expect from them going forward?
Well, when we talk about this, we always have to go back a little bit in history, because we have to recognize Japanese institutional investors were no real estate investors. To make them only in 2014, the then Prime Minister Abe started to encourage institutional investors to invest into risk capital, meaning stocks, infrastructure, and real estate. And those institutional investors didn't even have the internal facilities. They didn't have the teams for real estate. So they had to bring in then teams, sometimes from banks that were involved in real estate financing, other times from many American investment banks. So there were some prominent hiring. And then these people were able to build up teams. And in 2015-16, those institutional investors started to invest into real estate in Japan, and from 18, 19 started to go overseas, started to go first to the United States, then at a later stage also to Europe, first into the debt market, and after a while then into commingled funds. So we don't see them yet because they are mainly involved, especially in Europe, in commingled funds. Few of them are now starting to look into individual transactions, let's say at least for cup deals. These are the very large ones that now team alliances with other partners to do club deals in Europe. But we will see those investors much, much more going forward, because the appetite for real estate investment is tremendous. If I just take the four largest investors, which are the governmental pension fund, Japan Post Bank, and Japan Post Insurance, and then the local pension funds, these four groups together have at least, they have until now only allocated 3 to a maximum of 5%. And if I take these 3 to 5%, then I come to an aggregated investment need of 350 billion. And out of that, at least 40% should be invested overseas. So you see from these numbers what can be expected over the next years. It will not be a process that will explode in those markets quickly, because Japanese investors, different from other investors, do not go to markets and say, we have 500 million, can you find me some properties for it? Japanese investors, first of all, look for the partners with whom they want to work in those markets. So that is a process that takes time, because they want to understand the partner. They want to see what the partner is doing and then get a feeling for it. But that is a process that is starting right now.
Yes, absolutely. Thank you for the observation. Hans, going back to your slide about the deal volume, I thought it was interesting that you had an opinion that the value adjustments really have been already completed, or mostly completed, with maybe a little bit further capital decline in the fourth quarter 23, and that your advice to investors is that the timing, you shouldn't wait too long for the right moment to strike. My question is, what's your forecast in real estate transaction volume, for the remainder of this year and next year? Obviously a loaded question, but I wanted to get your take on it.
Yeah, so it's a great question. To be fair, we don't have an official published forecast on transaction volumes. It's a very difficult thing to do, but so we limit ourselves to forecasting the rental growth and the yields and the total returns, without necessarily commenting on the volumes. And the reason for that is, especially in today's market, it's actually very, very hard because of the issues remaining with the refinancings, but also the bid-ask spread between sellers and buyers. So to come back to your question about valuations, we have probably seen a little bit more quickly an adjustment in valuations that we might have seen in the past, which is sort of good. I mean, certainly in the UK, perhaps a little bit less so on some of the continental markets. But, at the end of the day, the prices, a lot of sellers are not yet ready to accept those valuations, and therefore they don't, if they don't need to sell, they won't. And that's why we see this spread. And as long as you have a large bid-ask spread, the transaction volumes will necessarily go down, because in a lot of cases, the buyer and the seller will not be able to negotiate to a successful price where they actually exchange the ownership. And then it's very hard to even come up with sort of these estimates, because we're looking back to 2009 and 2010. We're looking at refi problems. My gut feeling says that we probably won't be quite as bad as 2009, because also the market, as you mentioned earlier, the transparency has increased. But also, I would say that liquidity has become better. So even in less transparent markets, with the right help from advisors like JLL, lawyers, and tax consultants, you can still do deals, even if the transparency is not perfect. At the end of the day, I always like to tell people, transparency is interesting to look at, but actually liquidity is the proof of the transparency. So you still see deal volumes. In fact, some segments of the market that have traditionally been quite untransparent, like hotels, for example, they have actually still shown quite strong liquidity in the recent market. But maybe just to come back to a point that Leonard mentioned, as far as the approach of Japanese investors to global markets, I would definitely concur with what he was saying, that they are very patient investors. They are focused on building relationships with local partners. We've certainly seen that here in the European market. There have been a number of large developers coming over to the European market that have done some really high quality development. They have learned a lot of lessons working with their local partners. And I think it's it's a testament to that longer term approach that now they are starting to come back to the markets more actively and buying partial interest from some of their partners that they already know, that they have the relationships. I think this is a very good way to approach investing. Look across the cycles, be patient, don't get carried away with short-term trends, because in the end, you're not investing for a 3 or 4 year period, you're investing for a much longer period. And I really like that approach, and it's encouraging to see that they're coming back to some extent as global players now in markets that are perhaps a bit more distressed. We do need their help. Of course, they're getting attractive pricing as well, and I think that is maybe something, Leonard, that is maybe consistent with what you've seen as well.
Yeah, and especially in this market right now, many of them have the potential to come also as pure equity investors. So they do not necessarily need debt finance, or the other way around. One of the large investors that we do know very well and that has quite significant investments in Europe already, they have no debt at all. So they have also no problem in this situation as you described it early on.
Yeah,
that is one of the strengths. I mean, they are number one, as you described already, their business approach, and also before, they are long-term investors. So if they buy a tower somewhere, then they want to keep this tower and not sell it after 5 years, like we have seen it very much from Korean investors. That is also something for the safety of the occupiers in that building and the partners. If you partner up with a Japanese company, that is a long-term partnership then.
Yeah, absolutely.
Absolutely. I see Bill coming on. Bill?
Yeah, thank you, Hans and Kai and Leonard. Just excellent information. So much to consider. We have a few questions, but one, Leonard, you mentioned that people are coming to Japan, other banking institutions, other central banks. Japan is clearly contrarian right now. How are these meetings going, and what is being said, and what do you think the takeaway for other governments are?
Well, I cannot say so much about what the governments who come here say. I mentioned that Ms. Beiwitz, the German urban minister, was here because we have also in Germany a shortage of housing, and housing is not being built fast enough. So she was here to learn from Japanese developers, construction companies, why are things in Japan differently? Why I mean, this is also something that all investors cherish very much when investors invest here at an early stage in a development, that the development is reliable, the development is ready on time, and you don't have any surprises. This reliability of the developers or the construction companies in Japan is something that those investors who have the ability and also who want to come into a property at an early stage, maybe just in order to secure it, they cherish the reliability of building in Japan.
Thank you. Another question, Kai, that came up is, and so it's only a small question, that is, where are interest rates going and when do we expect any softening, whatever? Yesterday, interest rates hit 22-year highs globally based upon where they've been. We've had these seminars before and webinars before where we always ask people to crystal ball. I know it's very, very tough, but I looked at some of the notes. We were going to soften somewhere around now. We're not. What about 2024? The new catchphrase up in Canada is stay alive to 25. So if I was just to go around quickly and ask the three of you, what's your forecasting telling you about these rates and when they might either soften or come down, or are we just in extended period of uncertainty? So I'll start with Hans.
Yeah, thanks very much, Bill. That's a great question. It's one that we get quite a lot from clients and other people as well. And my answer has to be that if I was smart enough to be good at estimating these rates, I probably wouldn't be a real estate researcher. I might already be retired to some tropical island. But just all joking aside, I do think that as a real estate analyst, most of our clients do not really come to us for macroeconomic advice. They come to us for real estate advice. So what we do is we try to find the smartest people that do this for a living. So we look at the consensus across different macroeconomists. Now, they get wrong quite a lot of the time, as you already highlighted. We try to stick with consensus just because again, it's hard to justify, especially if you have 20 different countries where you need to do forecasts on property market. It's very hard to come up with GDP, inflation, and bond yield forecasts for all of those 20 countries. So it's a bit of a cop-out, I'm afraid, from my side, but we still do the scenario analysis by looking at upside and downside scenarios. So that's the official answer. I do think that it would be reasonable to assume that inflation is coming down relatively quickly now. That 2024 will probably be the year when bond yields start to normalize because central banks will have done their job and inflation will come back to what their targets are. So for Europe, I would say 2024, maybe for the UK. Obviously, the UK in our mind is still part of Europe, but they are still a separate story. It could be a bit later than that.
Thank you. Leonard?
Well, let me answer for the Japanese market because that is my turf. And as I mentioned, we have not seen here any interest increases. I'm not going to say that this will not change. It will change at some time, maybe at the later time of this year. I mentioned during my presentation, the Bank of Japan may consider to stop having a cap on the 10-year government bond, which presently they keep at below 0.5%. That may be changed. But we will not see significant increases in the interest rates in Japan for a foreseeable future.
Thank you. Kai?
Yes, really the one thing I would like to add is just based on JLL research, the average length of plateau before subsequent easing is about 9 months. So that is our house view. Obviously, this is what research is telling me. I'm, again, not super smart on this topic, but that's generally the view that we hold.
Thank you. We're right up against the hour, so I'd just like to add a few closing remarks. First of all and foremost, thank you, Kai, Leonard, and Hans, for just excellent presentations. We hope that we see these, your thoughts in real estate issues and other CRE forums and platforms. And Hans, thank you for European perspective and also the European chapter for the great conference in Prague. Leonard, to your colleagues in Japan and Asia, we are so proud and delighted to have a new Asian chapter. And I'd encourage everybody who's a counselor and beyond to take advantage of this wealth of knowledge and talent in Asia now. Kai, great presentation. It's very clear that global markets are navigating many, many challenges, but they aim to be resilient. The segue between transaction volumes, availability of debt, interest rates, and servicing those costs remains to be very, very interesting and challenging going forward. But one might say that these are times meant for experienced, innovative, and credentialed problem solvers, much like the counselors. Please look forward to upcoming announcements about other webinars that we're going to be presenting. Until then, on behalf of the counselors of real estate, thank you for attending this session of What's Next for Real Estate and the Life Experience. Please go to our website and just use the resources available. Thank you all for attending. Thank you, panelists, and everybody have a good rest of your day. Goodbye.
Thank you, Bill.
Right. Thank you.